All right, good morning and welcome back to the Money Advantage podcast. This is Rachel Marshall and Bruce Wayner, and I think that we are live. Let me double check. I'm not sure that we are.
Not on YouTube.
Bear with us one moment. We have an important conversation for you today about inflation and infinite banking, fractional reserve banking, and we want to make sure that we are live so that you can hear it.
It looks like we are on YouTube now.
All right. Yes, I see that we're live. All right. So we're going to jump into this topic today because there is a lot of misunderstanding around the idea of banking and what banking is and what it does, and really what you don't know can actually hurt you. We're talking today about is the concept of the way that we typically think about banking and using and participating in banking as we know it, is that actually hurting the economy? That might sound like a outlandish question, but today we're going to dive in because there are a lot of things with fractional reserve banking in the American economy that cause an inflationary currency supply. And because of that, when you have inflated currency, you have more dollars in circulation that causes inflation, where each of those dollars becomes worth less. So because of the nature of the way the banking system works, we have an opportunity to not participate in that as much as we can to take the banking function into our own hands through a process called infinite banking, which is a sound money solution to fractional reserve banking and inflation. And today that's what we're going to talk about. We're going to talk about how you can be a part of not hurting the economy, how you can be a part of seceding from a system that in even its grandest, best intentions can end up going down a path of causing inflation and what we can do to prevent that. So Bruce, I'm excited for this conversation today. I think this is something that is important mostly because we all feel the effects of inflation, and there are so many opinions and different economists, schools of thought that go about discerning the reason for the problem and how to fix it in our world. And we get the common dialogues about, well, just change the interest rate, or we need more dollars to do this, or we need to think about what's happening with the national debt. There's so many things that are impacting the economic factors around us. And instead of just feeling those effects of inflation, we want to give you some actual practical tools of understanding so that you can be in the best position possible. So Bruce, that is my thoughts as we jump into this conversation. What are you hearing, boots on the ground, as you're talking to people about this question around inflation and this question around the banking system?
Yeah, unfortunately, this has turned into a political discussion, and so you get two sides of it. You get the one side that's a more traditional liberal aspect, and they will say, well, inflation is caused by the greed of corporations and business owners. It has nothing to do with the money supply. It's just that business owners and corporations want to set prices higher. The other side says, no, that's not the way it works. Is the fact that the matter is that there's just more money in the system, and if there's more money chasing fewer goods, then prices are going to rise naturally because of the free market system. And that would be the Austrian way of thinking. Ludwig van Mises and von Mises and Carl Menger and others who actually Carl Menger actually authored the books Principles of Economics. And then, of course, our friend Bob Murphy's been on the show a couple of times. An Austrian economist would agree. I actually I'm going to do a thought experiment right now with a couple of people, and it may be a little difficult to do over the podcast, but so I want everybody that's listening to the podcast right now, whether you're listening to it live or whether you're listening to the recording, to think about that you have an extra $500. So you have $500 that you can spend on something. And then I have my Apple AirPods right here. And my Apple AirPods I am going to suggest a price. And this is what business owners do. I always say business owners only suggest prices, but the consumer actually sets the price. And that's very hard for a lot of people to understand because they're like, no, no, no. The business or the corporation sets the price, and then I have to pay it. Well, no, you choose to pay it. That's the difference. And this is the emotional part of it because people say they say, well, I have to have a car. I have to have, this dress. I have to have my nails done. I have to go play golf. I have to have food. They all say those things. And the fact of the matter is, no, you choose to do all those things. Now, I understand that some things to stay alive, you have to have like food, water, so on and so forth. But you can actually shop around and negotiate what the price is going to be. So the business or corporation suggests the price. The consumer, from their behavior, actually sets the price. Because if I have this Apple AirPods right now, and you have an extra $500, and I say, okay, I am going to set this price at $300. You may say to yourself, okay, I'm going to decide, I only have an extra $500. Am I going to spend $300 on these Apple AirPods? And then you're going to make a decision and you're going to buy them along with some of your friends, other people in the world are going to buy them. And depending on how fast they move, according to how much it took to produce them, Apple's going to make a decision and say the next week or the next day or the next month, they're going to say, you know what? These are selling really, really well. We're going to suggest a higher price and see if they still are sold at that higher price at the same rate. If they aren't being sold at a very high rate, Apple says, we're going to suggest a lower price and see what the consumer does. And so the corporation is setting the price at 300. You have an extra 500. You make that decision and you're going to decide, yes, I'm going to buy them. Or you're going to decide, no, I'm not going to buy them. Now, here's where the thought experiment comes in. The government now, through lowering interest rates, allows more money to come into the system. And when more money comes into the system, you can actually have money that is delayed. You don't have to delay gratification because you can actually obtain that from a loan or a credit card, or because more money has come into the system, it's cheaper for a business or corporation to obtain that money, and they may actually pay you more in a wage. So if you pay more in a wage, you also get more. And that has to do with supply and demand of labor.
Mm-hmm.
So now suddenly you don't have 500 extra dollars. You have 700 or 800 or 1,000 extra dollars. So now when this price is set at 300, you thought it was a pretty good deal when you had 500 extra dollars, but now you have 1,000 extra dollars. Well, I want to challenge everybody out there listening. Are you more likely then, because you had more dollars at your disposal, to make a quicker decision to buy it at $300? Well, of course you are. So more are going to fly off the shelf. So then Apple's going to say, oh, well, we have more dollars chasing fewer goods. We are going to ramp up our production. But in the meantime, we are going to suggest a higher price and see if people are going to still buy them at that higher price. And guess what? Because they have more money, they are. Oh, we're going to suggest a higher price next month. And people have more money, and there will come an equilibrium time where now the production of that particular goods or service is equal to the amount of dollars in the system. Now, you can accept that. That's the Austrian view. That is, to me, that's a logical view. Or you can accept the other view where it's just corporate greed setting the prices higher and higher. And my I will finish now with this introduction by saying I don't see how a person can realize that a corporate view of greed can be sustained, because once those dollars are gone out of your hands, you have no more dollars to buy goods and services at a higher price. So now the corporation has to lower it. So it's not greed, it's suggestion where they can actually set those prices.
I think it's very interesting to consider that when you look at dollars and the price of goods over time, it can seem like house prices or the market rate of the houses, the housing market is going up, and the dollar value of gold is going up, and the dollar price to buy food is going up, and the dollar price for everything seems like it's going up. But when you really look at things, for the most part, you realize that the same amount of if you tracked it outside of a fiat currency, outside of the dollar, which is an adjustable valuation, but if you tracked it with something like gold, the same amount of gold would still purchase the same amount of a tailored man's suit as it did about 100 years ago. And so you look at the fact that things are more expensive in terms of the amount of dollars that are required. It also is showing that our dollars are worth less because there's more dollars in circulation in the economy that are chasing the equal amount of goods and services. There's so much to this as well. It's not simple just to say, well, you fix something by adding more currency. You fix the problem by taking currency out of circulation. It's not just that simple, but what ends up happening is we have a Federal Reserve that was created, and that then we have an entire banking system that is based on fractional reserve banking. We have deposits, we have loans, and we're going to talk a little bit about what that means, but all of those are inflationary. They all add currency into the system. And when you look at what's happening with that, we don't, it's a problem when it's creating inflation. We don't necessarily recognize the mechanism, but the effects of it are felt through added currency supply and things having more expense.
Yeah, and Bernard Clements is listening right now, and he said that's true unless on elastic, and what he means is that you can actually stretch the prices up and down, but it's not true on inelastic things such as Medicare, because that price is being set by the government. Now, I would say that I would still argue, and I think it's a very good point, but I would still argue in the very long term that those prices are set by the government because they are also um, they are also going to be determined by how much the government feels like they can extend, such as the Medicare program, unfunded liabilities and still get the taxes from the citizens. And
Mhm.
so, although it is inelastic on a very short period of time, there could be elasticity that could be um, gone over a long period of time. And Bernard says I'm absolutely wrong 100%. Well, I'm not saying I'm right 100%. I am giving theories about how this is actually working. So I'd appreciate it, if people would open their minds a little bit and just use some logic on some of this stuff. Um,
Mm.
I would say that before the Federal Reserve, if you saw this, that there wasn't as much inflationary pressure. So then, how could you eliminate the fact that there is no correlation to that? There may not be 100% correlation to that, but there has to be some correlation. Oh, I'm sorry, Bernard. I'm reading off my phone, and he said medical care, not Medicare. I I understand how that is somewhat inelastic too, but I would also say that there is some elasticity on that. Or why do hospitals now actually advertise? And Bernard, I just got, it's funny you mentioned this because I am just leaving my house today and I took the mail out of my mailbox and I'm getting, and here was what the flyer said. Please attend, please attend a gourmet dinner if you have these following medical issues, and we will help you solve those issues. So here is a doctor that is actually advertising, and that advertising then would be for services that seem to be elastic to me. So there may be some things that are inelastic, but I think most of the economy is run on elasticity. So I I get your viewpoint, Bernard, and I appreciate it. And thanks for listening. Um, and thanks for participating. Well, he says now try to negotiate medical care or prescription drugs. Well, actually, I just did this personally. Um, what happened was I need some anti-inflammatories for my eyes. My insurance company doesn't cover it. So I went to one pharmacy. They said it would be $206. I went to another pharmacy. They said it was $118. So guess where I purchased it? I purchased it at the other pharmacy. So I do think there's some negotiation. Now I didn't go to the first pharmacy and said, I will pay you less.
Mm-hmm.
I didn't do it verbally, but I
You
did it
voted
with
with your
my
dollars.
action.
Yeah.
Right. I voted with my action, with my pay. So I understand that some prices are set and you cannot go and do that, but I believe if if hospitals and doctors are going to continue to actually advertise, and actually if we make pricing more. Another one was my wife just last year in October had a MRI that she needed to be done. That her doctor insisted that she do an MRI with their medical group. It was $3,000. My wife thought she had to do it. I said no. Get the the script. We're going to go to a metro imaging place here in St. Louis, and it was only $999.
Mm.
So once again, we voted and negotiated with our money, and we took charge. Now, I know what Bernard and a lot of other people say. In emergency situations, you can't be laying
Right.
on a bed and you say this. But I'd like
Mm-hmm.
to kind of get off this topic because I'm not saying that everything is not controlled by something, and the consumer can't sit there and negotiate. What I'm saying is a large enough group of people that actually vote with their dollars going somewhere else could actually vote this. And that's the majority of it. I'm not saying it's all of it, but it's the majority of it.
So what's really interesting is this whole idea of if you had additional dollars, would you choose to pay a higher price for something? The seller then can set a higher price because people have additional dollars to be able to put into something. But what about once that dollar goes through circulation? So you had more dollars. Just say you were the only person who had more dollars. Now you pay a higher price that goes to the seller. The seller has more goods, more dollars compared to everyone else. I'm changing your thought experiment a little bit, but now that seller, the merchant that you were going to buy the AirPods from, now they have more dollars. They're able to go purchase at a higher price than everyone else comparatively something that they want to purchase. But as those dollars get into the economy, now all of a sudden, as those dollars, you follow them around, well, now I don't know, the guy who sold the AirPods now bought some, I don't know, fresh salmon that was caught out of the ocean, and so they pay a higher price there. Well, the seller of the salmon now goes and purchases a sofa and is able to pay more because he has more dollars. But now when all of those, the trail of those merchants can set higher prices because they know somebody is willing to pay them, it then shuts everyone else out of being able to make that purchase. And also when you go back to purchase, now you want to pay for those AirPods. They were $300 last week. Now they're $500. You say, wait a minute, I don't have any extra dollars to put towards this. I wanted to pay $300 for it. You can have a trailing effect of inflation that is challenging for you to keep up with. There's also just a lot of governmental interventions and things like setting minimum wage higher and higher and higher. Well, then the company has to pay more to its workers, which means it either is going to have to lay people off or find a way to become more efficient. It's not all bad, but the challenge that can happen is that they may have to raise their prices to increase their income so they can afford to pay the workers, and it can become a vicious cycle. So let's go ahead and look at kind of some of the starting points of this, because what's really interesting about the inflation challenge, the inflation problem, is that there are roots of it in the Federal Reserve and fractional reserve banking system. And so for lack of, we don't want to make this an entire history lesson today, but Bruce, I think it's really important for people who are listening to recognize what is happening with banking, with the banking system and fractional reserve banking, and why that is inflationary, and how we can recognize that deposit banking and using banking as we normally think of it to get loans and get cheap capital to be able to invest places can actually end up as a macro hurting the economy. So Bruce, I'm just going to share kind of a big picture point, and then I'm going to let you kind of dive into some more of these details. But if you look at the nature of banking, say you deposit a $1,000 check into the bank. The bank is not holding that $1,000 in cash behind their safe and their bars. And every single person who's depositing $1,000, they're not keeping all of those $1,000 for you and $1,000 for Bruce and $1,000 for Joe Schmo on the street, and all of the checks that have been deposited are not held in the bank. So what is happening is they have to keep a portion of that, a fraction, in reserves. And right now that's in the ballpark of, I think you call it 10 to 1. I don't know if I'm saying the ratio correctly, or 1 to 10. Which way?
1 to 10, yeah. 10%, so 1 to 10.
Okay, so they have to keep $1 in reserves for every dollar that they have pledged in deposits. So then what happens is they're able to loan out additional dollars. And as they loan out additional dollars, they are able to provide loans into the economy, which just by the very nature of getting a loan, you are creating dollars that did not previously exist. And because of doing that, it puts more dollars into the economy by using loans. And then because of that, those dollars are worth less. So that's the definition of inflation. Bruce, I'm going to have you just share what your additional clarity around that idea. And again, I don't think we need to get deeply into the weeds and the historical nature of this and all of the moving parts, but what do you think is important for somebody to understand about fractional reserve banking?
Well, I think the first thing is that we ought to go back to the history of banking. You know, before there were actually physical banks, people actually anything that they had that was valuable to them. There was a couple of different things that were a couple of things that were difficult for people. One is they needed to protect any wealth that they actually had, and that wealth could be not just what we consider traditional wealth now. I'm not talking about like people had gold coins that they would literally just carry around with them, which was not good. One, you could lose them. Two, you could very easily have a person steal them from you. Secondly, it could be something that was on the barter system before, where you might have chickens or cows or grain or something that you were bartering. The same thing is it's very clunky. There's a lot of it. You would have difficulty trading because you have to, if your wealth was tied up in chickens and you needed lumber and that person didn't need chickens, well, that was very difficult then in a barter system.
Mm-hmm.
And so then currency type systems came around. The first banks, the first banks were not because people were trying to get loans. They were actually because people were trying to get protection on their money. So they would actually pay to protect their silver and gold coins or other things that they had, and they would pay somebody to protect them. Well, what they quickly realized when they were doing this And there's some great YouTube videos on this from Khan Academy, Khan Academy, great educational platform. It's you might call us biased, but I would say that most people don't think Khan Academy is biased. And I try not to be biased. I'm just trying to give you some facts here. Is that these banks soon realized that a lot of people were not coming back all the same time and asking for their gold and silver coins. So then they said to themselves, well, what if we start to lend this out? As long as we don't lend too much out, a lot of people won't come back and we'll be fine. So they started lending it out at an interest rate, and then they would get paid back. Well, then that started working pretty well, but they got nervous because too much of that money was out. So they said, how can we incent people to bring more money to the bank? Well, the way they can incent them is to pay them to access the capital. So they said, now instead of paying us, we're actually going to give you an interest rate just to bring your money to our bank. And when they did that, then now they would have more money to lend out. But really, they can never lend out more money than they had in the bank. So that was kind of a one-on-one. Now they had to be pretty smart about it. They didn't want to go too far into the reserves, because what if a lot of people actually came for the money? That's called a run on the bank. And so then what was replaced, I would say, somewhat responsibly, although I didn't necessarily agree with it, but somewhat responsibly, is the Federal Reserve System said you could actually lend to banks overnight lending and keep the reserves at a certain amount, and you have to pay us to actually give you those reserves. Well, that just meant they had more money. And so if they had more money, now they don't have to worry about as many people coming back. And the Federal Reserve set that at somewhere at 10% because they would cover it. Now, and actually at times of the Great Recession, I believe they actually took off some of those reserve requirements. It was even worse. Now, so if you understand that, where they say you only really have to have 10%, and I actually experienced this. I talked about this on a podcast before. I went to my bank one Thursday. It might have been a Tuesday. Yeah, it was a Tuesday. And I said, I'd like to get $5,000 in cash because I was going to go buy some silver. And they wouldn't give it to me because they said they didn't have it at the bank. They would fall below their reserves. And they said, we're going to have to be clear,
it. You weren't asking for a loan. You were asking for your money.
I was asking for my money back.
Account.
Yes. And I had a lot more than $5,000 in that account. And they said, you have to come back on Thursday because we're going to have to order it. Well, where do they get it? They get it from the Federal Reserve. So I came back on Thursday. So if you think all of your money is in the bank, you're badly mistaken. So what that happens then is that means that if they only have to have a reserve requirement of 10%, it's actually even worse than we've already started, because now I lend it to a construction company. A construction company actually purchases equipment and supplies. They also pay their workers. The workers and those supply companies now take that money and they put it in their bank. So it builds up the fractional reserve in that particular bank. That bank now is now allowed to lend it to their people that they have relationships with. And it just keeps getting repeated. And the Federal Reserve then will actually change how fast it flows in and out this is a very rudimentary way of thinking about it, but by lowering and raising interest rates, because it will slow how much people will take it out. And the other thing they will do, and this also causes some inflationary processes, is they will actually not even approve loans. It's happening right now. They're nervous about the economy, so that they have tightened the loan that they will give to certain people. So it's not only the interest rates, but they will tighten the loans that they will give for people to buy homes because they're worried about the housing market crash. So their collateral will go down. Well, that means you have more people that cannot get loans. And so you have a situation where housing prices now, because the builders can't build more, and because the interest rates are too high, and the people that are sitting in homes that would like to either downsize or go up in a home, they have interest rates that are very, very low from the last 10, 12 years. And they're like, well, if I move now, I'm going to get a higher interest rate, so I'm not going to move. So the inventory is way down for this. So supply and demand now says, okay, there's not very many homes. So there's more dollars that from the baby boomer generation that don't need loans to actually chase these fewer homes. And that causes prices to go up. That's been going on for about 2 years. I just saw where it's actually flattened out last month for the first time. And that's part of what we want to communicate in this particular podcast is, yes, you're going to see these wild swings, but if eventually the equilibrium is going to happen, the right amount of dollars are going to be chasing the right amount of goods, and you're going to have not a flat line, but you're going to smooth out these prices going up and down. That's the way the Austrians would like it. Quit manipulating to try to get what you want and just let the free market decide what the prices are.
What's really interesting about all of this as well is that you have the loan system within the banking function is that if you have, say, you've deposited your $1,000 check, that now becomes, if they're in a 1 to 10 ratio of their reserve requirement, that $1,000 becomes the reserve for which they can then loan out an additional $9,000. Bruce, correct me if I'm wrong on the math there, but you put in $1,000, that becomes a reserve. They can loan out 9,000 additional dollars. So you're creating dollars by your deposit. And what happens is that is an inflationary act. Even just having dollars on deposit with a bank and then participating in the loan system as well. And so when you look at a macro level, when you have everyone using that fractional reserve banking system as a deposit mechanism and then relying on loans to be able to finance their purchases, all of that is inflationary.
Yeah. Yes, it is. And we have some great dialogue going on. I think this shows just how frustrated people are on both sides of the issue. And I want to get back a little bit. Once again, I must not be communicating really well. So like Melina says, a negotiation, she doesn't agree with me that you're negotiating all prices, because she says try to do that at Costco or Panera Bread. Well, I would agree that you yourself cannot go into Costco or Panera and say to Panera, I'm not going to pay you $3 for the cup of coffee. I'm only going to pay you $2.50. Will you take it?
But if you choose not to shop there because you shop somewhere else, and if enough people do that, I mean, that is negotiating
exactly
prices.
Right. That is negotiating prices. And that's the point I'm making. Same with Costco. If you go into Costco and you say, oh, this rotisserie chicken, you have set at $7, but at the end of the day, they still have 2 dozen rotisserie chickens sitting there because people did not buy them and they left without buying them. The next day, if they have any sense, maybe not exactly the next day, they might try it for a week or so. They're going to say, oh, we're not selling it as a 7, so we're going to lower them to 6. So you're not negotiating individually with your voice, but you're negotiating with what you're buying, you and all the other citizens that are going into those things.
Well, because really every single purchasing decision you're making is ascertaining your value. I mean, it is stating with your actions what your value is and what you're willing to pay. I mean, if somebody you're going to hire a landscaper for your lawn and they're going to tell you it's going to cost you $14,000 to mow your grass each week. I mean, depending on the size of your lawn and the beauty of of your mowing job, I mean, most people probably aren't going to pay $14,000 to have their lawn manicured per week. And so if they set a price too high, no one's going to be able to make that purchase, or no one's going to choose to make that purchase. If the price is extremely low, then the demand will be such that they won't be able to have enough supply to meet that. And so that's what you're talking about with the free market fluctuating or changing their prices based on the vote of the consumers as a macro, as a whole.
Mm-hmm. Yeah, and thanks for everybody that participated. We see our regular listener Fritz actually chiming in. Thanks, Fritz. This episode was inspired by Fritz's comment last week. And so now we'd like to finish up by actually talking about how, if you believe that fractional reserve banking, and I'm not saying you have to believe this, because there's a lot of people that obviously don't believe it. But if you believe that fractional reserve banking is actually hurting society, then you can actually secede from the system, and the same thing should happen. Because if you say to yourself, I want to actually just save before I purchase. If you save before you purchase, you're not using a banking institution that will actually have your dollars to inflate, because then they can't actually do fractional reserve. And as Rebecca Wilhite pointed out, and I did too, the reserve requirement temporarily is actually sometimes zero. And so if you want to secede from that because you think morally, and you also think it's better a system for the economy that you're living in, you could say, instead of putting my money in a bank, you could actually put it with an insurance company, because an insurance company will let you borrow against your money, but they will not let you borrow any more than the money you have in the bank. And they won't let anybody else borrow against your money. So it's a one-to-one collateral that is actually happening. So there's no fractional reserve going on there.
Which means if you have $100,000 of cash value, and Bruce, we talked about this right before the show, but if you have $100,000 of cash value inside of your specially designed whole life insurance policy designed for infinite banking, you can borrow against that 100,000, but they don't have the ability to go turn that 100,000 into $1 million through fractional reserve banking. They can't just lend out $1 million on your $100,000 in cash value, which is like a deposit with them. So you also said, and we've said before on the show multiple times, that they have even more than just dollar for dollar reserves. Can you speak to that for a minute?
Yeah, so the top 10 mutual companies on average actually have $7 more than a 100% reserve. So they have $107 for every $100 that they have cash value promised. Now, where do they get that extra money? Well, they got it from their investments that they actually made on the premium dollars. They then take we talked about this last week. They take those premium dollars, they put them to work. They have expenses, they make money, then they have a profit. And because it's mutual, they share the profit with the policyholders, because you're part owner of the company, in the form of a dividend. But they actually put some of that profit into additional reserve requirements. So that's where they build up that reserve requirements from the profits that the mutual company has made.
So the reason why using a whole life insurance policy is different than using the standard banking system, specifically with the Federal Reserve and the deposit mechanism of putting dollars into a bank and having the bank then loan out capital and having that fractional reserve banking. The reason why infinite banking is different is because you're not creating an inflationary event by creating additional dollars when you are using your life insurance policy. And the value of that is that on a, Bruce, you mentioned moral, on a moral basis, on a personal basis, you are saying, I'm not choosing to create this inflationary environment, atmosphere for the rest of the economy. Now, if enough people did that and enough people said, I'm going to take control of my own financial landscape and my own personal economy, and I am going to save before I spend, I'm going to build up capital, and I'm going to borrow against my capital, and I'm going to be in a position where my dollars are not inflationary dollars. That doesn't mean you're going to prevent all inflation from happening, but it does mean if there's enough people doing that, that you're in a position where you're taking control, and rather than just being in a position where you're storing capital at the banks and then you're borrowing their money, you're in a position where you are able to borrow against your own capital, which frees you then from creating inflation, and you're in a position where your decisions that you're making are creating a sound money personal economy for yourself.
Yeah, and then there's so many comments today that we're not going to get to all of them, but I would like to get to one more. And I'm not a linguist, so I'm not sure how you pronounce your first name, Elu or Melina. He or she doesn't agree with me that the car is not negotiated because there is a blue book that sets the price you should be paying. I think you should research that, because all the blue book value is a culmination of how all those models and years of the car have been selling. So they're just taking all of the prices that those cars have been selling across the nation and then getting an average and telling you this is what the average person has been paying for this car. So it is a negotiation price average. Blue Book isn't a company that just says, oh, I think it should be this. Blue Book is just compiling all the records of how these cars and trucks have been selling. And if you
So,
don't believe
I
me,
mean,
just
maybe it
do
could be
some
like the,
research on that.
it's like the number that's the aggregate data of
Correct.
purchasers and sellers and their mutual decisions over time. I mean, would that be accurate way of saying that?
Yeah, that's exactly what it is. It's exactly what it is.
It also,
They get
go
the
ahead.
price from the DM. They get the prices from the DMV. They know exactly what those cars are sold for, and then they just aggregate an average. They don't set that price in the blue book. Okay, and if once again, if you don't believe me, just go do a little research on this. They are just aggregating the prices that have already been negotiated out there in the free market.
It's also possible that you could sell your car for less or more than the blue book price.
That's
So
exactly
if
right.
you are willing to sell your car that Blue Book says is worth $10,000, if you're willing to sell it for 2,000, I'm sure there's somebody willing to purchase it for that. And if you're willing to sell your $10,000 Blue Book value car for 14,000 because I don't know, whatever reason you made it a convenient purchase for someone else that didn't have to drive across the country to purchase the vehicle or something, and you added your own price to it, and somebody was willing to pay that, you can absolutely sell your car for more than that. So there's no rules. It's the agreement of the buyer and the seller, right?
Yeah, you suggest the price. The person that buys it sets the price that they were willing to buy it for. So yeah. So this has been a great discussion today. Obviously, I think it's an important discussion, or there wouldn't be so much engagement today. But I would challenge people to listen to both sides of the aisle and listen with the intent to understand, not listen to the intent to respond. Because I think this is what happens all the time. I do know that there are times when people feel like, oh, we cannot negotiate this price. When I say we, I mean the American citizens or the global citizens for that much cannot do this. Well, yes, you cannot do it on your own. And it may take a long time to move the price because of government intervention, but eventually it will. And I think that's the frustration with people that are like, I can't do anything about this because the prices just stay high and I can't buy it. Well, I understand why you think then there's some extraordinary circumstances working against you, some kind of conspiracy theory, but eventually those prices, that manufacturer will not be able to continue to keep those prices high. It's just, it makes no economic sense for them to do that. And that's what the Austrians believe.
So Bruce, I can link to Khan Academy. I don't know specifically which article you were talking about. There is one that's a financial institutions class within the world history course. So I was able to find that, but I'm just going to link to Khan Academy through the notes here, and you are welcome to go do some research. And also, Bruce, if you have a specific link for the course you were mentioning, I would love to.
I don't. It's so easy. I just plug it in, you know,
That's
Khan
awesome.
Academy bank discussion, and it comes up. It's not that difficult.
Awesome. I will link to that afterwards then. So if you are interested in really pursuing this idea of how to have your own stable reserves that you are storing and keeping so that you can access capital in any circumstance, you don't have to go to the bank to qualify for a loan. You don't have to worry about what interest rates are at the bank or whether they're going to be too high that's going to lock you out of a purchase. If you are interested in being fiscally responsible and being in a position where you are storing capital and being able to borrow against that, we would love to be able to talk with you and help you do that better through infinite banking and find out how you can apply these principles in your own financial life. You can do that by booking a call at themoneyadvantage.com to really just talk through what circumstances look like for you. So in closing, thank you for being with us today. Thank you for the discussion. Please continue asking your questions. All of that becomes fodder and just the fuel for further conversations to be able to help you make decisions that put you in the most financial control. So with that, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.